Let's talk about something slightly different then. So, inflation news has been driving the stock market higher today, and that's mostly coming out of the US. US stocks in particular have been picking up quite sharply. We'll come to those in a little bit. We thought we'd talk about something really exciting though, and then we thought, let's not do that. Let's talk about Persimmon, a house building company that Steve has been looking at.
Yeah, headline at the moment is that they have cut their dividend policy, and they've tried to tell you that this is them trying to be prudent, but I think I'm going to tell you in no uncertain terms that they pretty much have to. So on the earnings call, Persimmon said it expects the housing market to contract. They're experiencing increased domestic and macroeconomic issues. Corporation tax is rising, as is developer tax. And all of this is true, by the way. Persimmon wants to ensure it has the cash to keep snapping up land in the coming years. Persimmon is well on track for its completions. It's finished just under 10,000 homes so far this financial year. It's down 754 homes on a year-on-year comparison, but they still look on hit to hit their original estimate, which was about 14,000 to 15,000 homes at top. Speaking about the recent dividend policy change by Persimmon, AJ Bell's investment director Russ Mould said the record of FTSE 100 firms that on paper were due to offer a double-digit percentage dividend yield is particularly bad when it comes to actually handing over the cash, and Persimmon now looks to join an inglorious list that includes Vodafone, Shell, Centrica, and when they were part of the FTSE 100, Marks & Spencer's, Evraz, IDS, or Royal Mail, as it was back then. So the house builder is redefining its dividend policy, and this looks set to end a run of 235p per share annual dividend payments, worth about 750 million a year to Persimmon, equivalent to a dividend yield of about 19% at Monday's price when I wrote this. So shortly afterwards, though, they've announced further struggles. Both sales and prices of new build homes have fallen. Cancellation rates are soaring at 28%, caused by recession fears and rising mortgage costs, just affecting affordability generally. In the last 6 weeks, the net sales per outlet has fallen from a tidy 0.8 sales per week to 0.48 sales per week. So while these sound insignificant changes, it means that the sales cycle on new houses has almost doubled. The average selling price over this period has dropped by 2%. Persimmon said its prices were now below market rates. Material prices are still pretty high, especially the materials used to build these homes, which have been ordered in the past, where they are falling, material prices, but not when you've ordered them in the past. Falling prices with X material costs is bad news. And it gets a little bit worse as well. So looking through their sales, Help to Buy was a huge proponent of their revenue. Roughly 1/5 of homes were sold via this now closed scheme. Will the LISA be able to pick up the shortfall? Persimmon's got a lot of questions ahead. So look, Persimmon are cutting back on land purchases too. They've snuck this in the day after their earnings. They're adopting a highly selective approach as we navigate the uncertain outlook for the UK housing market. They said land additions in 2023 are expected to be significantly lower than 2022. So this looks to me, Steve, like a stock that's having a little bit of an issue. Any thoughts on it?
It's a cyclical stock doing cyclical things to an extent. When I looked around sort of more broadly, I saw similar kind of news coming out of Taylor Wimpey concerning stuff like rising interest rates and harder to get mortgages and more expensive mortgages for those that do get them. And that shouldn't, I don't think, be surprising to many people. The stock was down about 9% following its trading report, which is down, and a significant kind of down, especially for a kind of UK stock, but it's not kind of earth-shatteringly cut in half down or anything like that. So I was thinking in this kind of situation, well, it's a cyclical and it behaves in certain ways. I suppose the thing that most stood out to me is that I don't own any kind of UK house builders, but I was quite taken with how much they appear to be, in a sense, dependent on certain government decisions. And sure, every UK company is dependent on government decisions to some extent because it's based in the UK and the government makes the rules. If they push up taxes, well, then profits go down. But I don't just mean in that kind of way. So what I'm looking at is stuff like the Help to Buy scheme and how much they were kind of dependent on that, and the government decides that's going to end, and then away goes 20% of your sales. There's also a kind of issue around cladding provisions. So following the Grenfell disaster that's sort of fairly well known about to UK investors, and probably more broadly than that, I would guess, Persimmon and various other home builders have to put aside money for cladding provisions on buildings. the amount that they have to put aside has been kind of hard for them to pin down, partly because they've been a number of government changes recently, which means there's been a number of different housing ministers, which has meant a number of different rules, one way or another. So they thought they had this fairly well covered and were guiding for having to put aside about 75 million. According to their last trading update, the amount they now think they have to put aside is about 350 million, which is about half a year's net income, which is quite a significant kind of chunk for them. So I can see how there's kind of more bad news than people were just expecting based on sort of fairly ordinary, everyone knows interest rates are going up, everyone knows mortgages are getting more expensive, everyone knows that means you're going to find it harder to sell homes. Cancellation rates, yes, they'll probably go up. Sales rates, they'll probably go down. And you'd expect that sort of through next year, even if this year isn't particularly affected. But I think that's the kind of bit that most stood out for me, exactly how dependent they are on kind of government schemes and decisions and those sorts of things.
Yeah, and that's the problem, isn't it? I mean, when, not to get too political, but there's been quite a heavy sort of concentration by the government on making sure property prices go up, and they get to a point where now interest rates are coming along that they've started to become unaffordable. So that's, you know, you're right when you say that they are reliant on government policy. So yeah, that makes things especially tricky for them. But I mean, Steve, did you ever think they were going to pay out a 19% dividend? I mean, that just sounds ludicrous to me.
No, I didn't think they were going to pay out a 19% dividend particularly, and I think the fact that they were kind of, I don't know, on paper scheduled to, in some sort of nebulous sense, is an indication that a lot of other people thought they weren't going to either. It reminds me of, we talk about companies as big dividend payers or small dividend payers. And we think of Apple as not a big dividend payer, for instance, because it has a yield of sort of just under 1%. And we maybe think about someone like Realty Income up around 5% as a sort of biggish dividend payer. That's not kind of automatically the way it works. I mean, dividend yield is a function of the market cap. So the question is where it gets bid up to by investors, right? You could pay out the same amount or more and go from being a big dividend payer to being a small dividend payer just because your share price went up a lot. So your yield went from 3% to 1% or something like that. So I think I view the kind of dividend yield here as at least partly a function of kind of people's expectations around these things, and a very high payoff means they thought there was a fairly high risk of them not getting that, and that's the way you would expect investors to behave, right? The riskier you think that dividend is, the more return you would want before you're prepared to put money on it.
Yeah, I mean, precisely. That's why it was priced like it was, because investors didn't believe that 19% dividend in the current macro environment was ever going to come to fruition, and they were proved right. So, I mean, Steve, you and I have a general rule about cyclicals, that we don't really like them when they look really, really cheap. And the reason for that is that tends to mean that everything has gone really, really well for them. They tend to have made record profits. That interest rate was probably facilitating them. There was low inflation. Therefore, everything that could possibly go well for them has tended to go well for them. And in something like a house builder, we tend to think when everything is going really badly for them and they look really, really expensive because perhaps their profits are very low or profits have been squeezed and they're laying off, that's usually a good time to buy something like a cyclical, because you're actually not buying it when it's at the very, very top of its cycle. But is that something you think for Persimmon now? Do you think we're just tipping off the end of their good cycle and they're moving into what potentially is bad cycle now?
Yeah, I think so. Persimmon, and this is not necessarily specific to them, and actually a lot of what we've said so far isn't specific to Persimmon. A lot of it is just true of house builders in the UK in general. Stuff about interest rates is not Persimmon's fault. But different house builders, I guess, they know that's how the cycle works, but they can leverage themselves to do better and worse, or to push a slightly kind of steadier path through these kind of things. And I'm not sure. I mean, it feels to me like Persimmon is the kind of company who thinks, let's make hay while the sun shines, and let's get out and sell properties when we can do it at high prices, and we will just kind of bunker down and kind of go off the cliff a fair bit when things are worse. But as long as they don't go bust out of this, and I don't think there's any suggestion that they're going to at the moment, this could be an interesting time to be looking in this space, I guess.
Well, they're very much like airlines, but with one key difference is they don't dividend out absolutely every dime of their income. So there's a good chance that quite a lot of the house builders will make it through this down cycle, however long however long it lasts. But I agree with you. They're interesting businesses. I think they are top cycle at the moment. I remember reading in the Discord, a few people were saying, like, well, every house builder's cheap, so I could just buy any one of them and I could probably win. And when you're looking at cyclical stock, that's alarm bells ringing for me. If you could think you could buy all of them and essentially throw a dart at them and no matter which one you hit, you win, that usually means you're at the top of the cycle and there's a hell of a lot of worry to come.
Yep. There's something similar going on over in the US as well, for what it's worth. I'm kind of interested in this for something more broadly that I was thinking of. A while ago, we sort of talked about Howden Joinery as a potential beneficiary of slower property market movements, and thinking that people might not move, but they might improve things. I was listening to a podcast this week that pointed out that people are more willing to do work on their home when they think their house price is going up, so they don't mind chucking 15 grand into something that's going to become 15 grand more expensive by the time they've finished doing it effectively. They feel a lot worse about it when house prices are coming down, which hadn't really occurred to me. It always sort of occurred to me that you just do stuff when you've kind of got the money for it and then just live in the damn thing when it's your house. But that was interesting, I thought.
Yeah, definitely interesting point. I just think it's a really sort of torrid time for the sector. It's why I don't really want to own any of the house builders at the moment. I was reading from an unverified source that Redrow are mothballing their biggest site. I mean, I definitely know from first hand that there's still a lot of building going on in my locality, but it has slowed. Whether the majors think that 0.48 sales per week, half a house a week essentially, or a house every 2 weeks, is worth them, continuing and completing. That's an interesting query. I just don't want to be involved in any of them at the moment. I am happy, as somebody inside the industry, to just watch for now.
It does feel like the very classic cyclical thing, doesn't it? When I was thinking about this, I mean, when I think of cyclical stuff, I think of the very obvious example of mining stocks, basically. And think of oil specifically, or oil drillers and that kind of thing. So when oil prices are high, everybody's pulling oil out of the ground because you can sell it for really high prices and so on. And then when oil comes down, it becomes not worth it to drill oil out of certain wells. So they stop them up, which causes the price to kind of come back up again. And it feels like that's exactly what's happening here to me, just with houses rather than oil, right? When house prices are high, everybody's building houses because you can sell them all for expensive prices. And then when things slow down, people stop building them at quite the same rate, I guess.
And I think, though, this is, just going back to your government point, I think this is a wrong point for us in this cycle to have more government incentive. I feel like we have inflated the housing market in the UK to such a degree that now even the slightest movement in interest rates is making them completely unaffordable. So that, to me, feels like very, very sort of bubble level territory. So I'm afraid I think the housing market has to be allowed to deflate now to come back to more sensible prices. Put it this way, if Persimmon can afford to pay a 19% dividend, they're charging too much for their houses, I think is the long and short of it. They're making too much money, and they're showing you really that these houses don't cost anywhere near the level of money. I remember back in the day, Persimmon used to get a whole load of crap because their CEO was getting paid about 100 million quid. So they've managed to bring that down to just, I think, a mere couple of million quid now for their new CEO. I think he's called Dean Finch. But I just think at the moment it's just too tricky for me. This is not a situation I think I am capable of navigating, even somebody who thinks I've got a pretty good grasp on this industry as a whole.
Interesting stuff.